Jason, good to have you. I see your latest note, thankful for a healthy consumer. So let's talk about the consumer and what your expectations are. You know, some would say kind of a mixed picture right now, and certainly some concern heading into the new year. Where are you?
Well, look, consumers are going to be able to spend more this time. In fact, the Retail Federation expects them to be able to hit record highs in terms of dollar level spending across the board. But the problem is they are facing inflation. And with inflation, they're actually going to be able to buy less this year in terms of magnitude of goods than they were in prior years. And the consumer's probably not going to be that happy about that.
All right. So what does that mean for your investment approach right now? Are you predicting that the consumer will be fairly strong, or are you more concerned perhaps than some others?
So, consumers going to hold in there. They're going to keep spending. They're going to keep spending their wallet because they are making more money, but they're going to be able to buy less goods. And that leads into this circumstance that we all find ourselves in, is the Fed has raised rates in reaction to inflation. Inflation's high, making spending at a item level lower, not at the dollar level. And therefore, we are facing a slower economic environment that is going to be hampering our ability to grow going into next year.
So just to dig into that a little bit more, Jason, we're starting to see weaker data, particularly on the industrial side. You could argue that you're starting to see some pain and some ripple effects of the tightening in areas of capital markets right now. I mean, is consumers and consumer strength sort of the last piece, the last domino to fall? And if that's the case, does that mean there's more pain out there for the equity markets to be had looking into next year as well?
It's one of the last holdouts. In fact, employment is one of the last holdouts at this point in time. Employment and the consumer remain kind of the strongest pieces. Capital spending is already starting to slow a little bit. Businesses are already feeling some of that pain. We're already seeing earnings estimates come down. We expect that to continue into next year under the pressure of inflation and higher interest rates going all the way into next year. The Fed's expected to keep rates at a level that's meaningfully above neutral all the way through the back end of next year at minimum. And that pressure will sit on both businesses primarily, but probably with ripple effects to the consumer, and that creating the mild recessionary environment that we're likely to face.
So where do investors put their money to work given that fact? And what do they steer clear of?
So number one place to put that is bonds. With rates coming up, bonds are more attractive across the board, and that's throughout the credit spectrum, although more investment-grade bonds are probably the more attractive place to be in the face of a recession. That also means if you're overweighting bonds, you're underweight equities, therefore with a modest defensive positioning within portfolios. Having said that, within equities, there are places to place money. Quality equities as opposed to the wings of growth or value cyclicals is a preferred place to be due to stability and less leverage on the balance sheets, as well as down the market cap into earning small cap companies, which are trading at material discounts in valuation to their larger cap peers.
Where does that leave international equities? You know, earlier in the year, there was a sense by some that China growth was going to be certainly better than it's going to turn out to be, maybe even Europe as well, that the U.S. might actually, in terms of, say, Q4 GDP, might be the silver lining on the global economy. Do you think that continues in the new year?
So U.S. is the silver lining for right now, and we're probably still going to look to be the better economy of the bunch of economies when you look abroad heading into next year. But that doesn't mean that we don't face some weakness going into next year. In terms of international equities, as you mentioned, that is where majority of the economic damage is being felt. The discounts are there from an equity perspective, but we are at this point in time still recommending investors stick with an underweight to international equities. Having said that, the currencies are down a lot, the stocks are down a lot. At some point in time, that portion of the market will actually get more attractive just due to the magnitude of the discount that is priced into those equities.